Hi and welcome to this month's mortgage market update. My name is Richard Purnell and I'll be taking you through the September mortgage update for all you buy-to-let investors that want to get a little bit more educated. So I always start by mentioning what's going on with the Bank of England, and it hasn't moved yet again. So that's now 18 months straight that the rates have been down at 0.1%. Why does it matter? Some people ask me from time to time. Well, there is sometimes a direct link to mortgages with the Bank of England rate or indirect link. So either way, mortgage rates do tend to move in sync with the Bank of England. So it is an important factor and something to be aware of. It still doesn't look like Bank of England rate's going to change anytime soon. And here's a little known fact. Since the Bank of England started back in 1694, this is the lowest the interest rates have ever been in that 300 plus year history. So, which is also then reflected in the mortgage rates themselves. So depending on your circumstances, it's the lowest rates in the land that you may be eligible for. Right, let's get on to EPC ratings. Again, hopefully everyone understands what EPC stands for, but for those that don't, Energy Performance Certificate. Since April 18, it's been unlawful to try and rent your property or sell your property without having this particular certificate. So why does that matter to you? Well, now the lenders are also becoming the gatekeepers where this is concerned, and they're starting to check whether, when you submit your application, whether that property meets the minimum rating. And the ratings can be anywhere from A through to G, but only A to E are seen as acceptable for lettings purposes. So if you have an F or a G rating, and as sadly some of my clients have found out from time to time, when applications go in, the lender's now doing that check and seen that it's an F and a G, and the case gets declined. It's as black and white as that. So, you know, as part of keeping a healthy portfolio, check that out. And here's a little heads up as well. Whether this comes to pass, we will have to wait and see. But the government are talking about bringing into effect in 2025. So what we've got 3 to 4 years on that, where the rating will be increased from E through to C. So you'd have to have an A to C rating to be able to let your property, and equally to be able to get finance on it. So yeah, watch this space. Right, but the good news, buy-to-let lender rates seem to be continuing to get cut. I've seen during August 5 lenders cutting quite significantly buy-to-let rates. So now I think a little bit of explanation needed here. Now, when you're talking about lenders cutting rates, I put lenders into 2 camps. So first of all, you've got the banks and the building societies, and they're in camp A. Sadly, I'm not talking about these guys. These guys get their money from current accounts and savings accounts and recycle that to the rest of us for mortgages. So in essence, they're self-financing. They can find their own money to lend out in the form of buy-to-let mortgages. So hence the rates tend to be lower with the banks and building societies. But the other category of lenders, these are what we call specialised lenders, or you don't see them on the high street, the non-banking lenders. So therefore they do not have that facility to access money through current and savings accounts. They don't offer those products. So they go to the wholesale markets. And it's these types of lenders that where I'm seeing the rates dropping. So that's great news for all us portfolio landlords, because you're unlikely to be going to the high streets anyway. And to just give you a quick sort of flavour, the lenders I've seen that are reducing rates are Aldermore, Masthaven, a company called West One. They're fairly new on the block, but they're very ambitious. Foundation and Fleet. You know, portfolio landlords are their bread and butter, so that is great news for those that are active in as portfolio landlords. Now then, limited companies reaching their sort of peak. What I mean by that is I came across a survey in the last couple of weeks. I think there's around 700 landlords that have been surveyed. And amongst all the stats and results that came out of that, one thing really jumped out in that 50% of all landlords said that their next purchase would be buying a property in a limited company. And that set me thinking, how many mortgage products are available in personal names compared to in limited company? Is that roughly a 50-50 split? Well, actually, the reality is you've got not twice as much, you've got 50% more mortgage products available if you're buying in personal name compared to in limited company name. That's a significant chunk more still when you're buying as an individual. And as we know, if there's more choice out there, that's where rates are lower. If you're buying in limited company name, so still, as I said, the choice is a lot smaller, and rates typically are at least 1% higher in limited company right now compared to buying in personal name. But what I'm really optimistic about is that if landlords are demanding more mortgages as a limited company, then I would expect more lenders to either enter this market or want a bigger share of this growing market. And hopefully, maybe in the next 6 months, it is me speculating, but I'd really like to see those limited company rates starting to drop, and I hope that happens. Finally, on this page, Accord, I want to just mention that they caught my eye in the last week or so. For those that don't know Accord, they are the buy-to-let arm of the Yorkshire Building Society, and they have tweaked their stress rate calculation. That sounds like a bit of jargon. So again, just let me explain briefly. It's the formula or the mechanism that a lender uses to calculate borrowing from the rental figure. As we all should know, borrowing is essentially based on how much is the rent on that property per month, and then it goes through a formula and converts to a pound amount of borrowing. And Accord have tweaked their formula to make it more generous, which is good. But that then leads me on to maybe spending the next 60 seconds on just expanding on the various factors that go into the calculation of how much you can borrow. Because not only is it good knowledge for you as a landlord to understand what lenders are looking at, but there are certain things that you can influence that may then mean you can borrow more money. So, knowledge is power. So let me just quickly talk you through it. So the first thing that lenders look at is the customer buying this buy-to-let in personal name or in a limited company? That's important because the calculation is more generous if you're buying in a limited company compared to in personal name, or it's potentially more generous. Which leads me on to the second point, because if you are buying in personal name, then the lender says, well, is this applicant a basic or a high rate taxpayer? And this might shock you to understand that if you're a high rate taxpayer, which you would think, well, surely that means I've got more income, more profit, surely I'm a better quality applicant. Frankly, it's the opposite that's true, that lenders penalise you for being a high rate taxpayer. Essentially, that means you're keeping less of your profit from a rental perspective. And so they also penalise you in that formula. If you're a basic rate taxpayer, they'll be more generous. So I'm sure as landlords, we're all trying to keep under that high rate tax threshold, but here's yet another reason to try and do that. Now, here's something that you can have a direct influence on. And this is about mortgage product choice. The two obvious examples are if you are choosing between a 2-year fixed and a 5-year fixed, a lender will always try and offer you more borrowing if you take a 5-year fixed. So you may prefer a 2-year one, but if the yield on that particular property is quite low, let's say 3, 4, 5%, and that might then mean that this property you want to get a mortgage on, you'd ideally want 75% borrowing, and it might be that your broker's saying, oh, well, we can only get 65% because the yield is low, the rental figure isn't strong enough. However, if you go to a 5-year fixed, as I say, the calculations are more generous, and it may be you get the full 75%. So do bear that in mind. If you're using a broker, they should be telling you that anyway. But for those of you that are still doing their own mortgages, you may not be aware of it. And the lender, it's luck of the draw whether they point that out to you. Okay. Property type, particularly this is if you're buying HMOs, for example, rather than a family let property, the calculation is actually more generous. And getting its own bullet point, holiday lets, because that's a little bit more complicated again. So, and it is something that as the applicant and maybe the broker as well can do some shopping around with different lenders, because there's no such thing as one standard calculation for working out holiday let borrowing. So to give you an example, the typical way that a lender would work out borrowing for holiday lets is ask you, the applicant, for what the typical weekly rent. So we're not going to get into occupancy levels at this point. What is just the typical rent during the low season, the mid season, and the high season? You then take the average weekly rent. This is gross, no deductions. The average of those three. Then the lender will multiply that by a factor to take into account what they think the occupancy level is. Now, that can change. This is where a good broker will understand the finer points of lending policy on holiday lets. Some lenders use 26 weeks. I've seen some lenders use 30 weeks, and I've seen some lenders use 35 weeks. And as you can imagine, that can create or result in a larger differential in the holiday let income that you end up with, and ultimately then what you can then use to work out borrowing. So understanding how lenders work out borrowing on holiday lets is very important. So you generally need to have that have those figures to hand. The last thing again is something that isn't widely known, I don't think, when I speak to landlords, is there's a small but sizable group of lenders who will use something called top slicing. Now, this is where, again, it might be a low yielding property. And if I use the analogy that you're buying that property, and even though it's low yielding, you still want to buy it because, for example, it's in a great area for capital growth, which is great for you, but a lender dismisses that completely. And so if the yield is low, you may struggle to get your full 75% borrowing based on that potential rental income. But this small group of lenders say, well, yeah, I get that. However, if the applicant can demonstrate that they've got personal spare disposable income, so they're looking at your own earned income, you may have a day job, deduct your own expenses, your lifestyle expenses, your personal mortgage costs, and if you can show there that you've got a reasonable surplus after those outgoings, then these lenders say, well, okay, we'll use that surplus money to supplement the low rent, and you could then maybe get your full 75%. So again, a good broker should be aware that these are out there, and turn those stones over to get you the borrowing that you need. Okay. Now then, this is something I bang on about every single month, and I make no apology for it. The reason I make no apology is that so many of our clients still, or people we come across, rarely have their life insurance in trust. Why is it important? Two reasons. One, if sadly your family needs to claim on that life insurance policy, then usually, if it's not in trust, that money, that lump sum, will go into your estate and form part of your probate, which the executors, solicitors, whoever's organising and dealing with probate has to then manage, which can take usually months, and I have seen it take in excess of a year for probate, what's called to be granted. And only when probate's granted do all the monies in that pot, in the estate, get divvied up to the beneficiaries as per the will. Now you imagine that you've left a family with kids, the main wage earner is now no longer here, so that income has stopped immediately, and you expected that life insurance to be paid out promptly so that your family could have that money to continue to keep the roof over the head, to keep the bills paid, to keep the mortgage paid, education costs, whatever it might be. But yeah, if it's going to take months upon months to happen, then clearly that's not what your intention was, and it's going to cause further distress to the family. By placing your life insurance into a trust, it takes it out of your estate completely. It doesn't form part of your estate, and therefore the insurance companies can make a payment out to the beneficiaries within days, perhaps weeks at the most. And that's, I'm sure, what you wanted. And the second thing, I've sort of alluded to it, because if a policy is now within this trust that I keep referring to, and it's not in your estate, then it doesn't get calculated for inheritance tax. So imagine if you were near your inheritance tax threshold anyway, then you've got your life insurance payout. And quite often I say that can be hundreds and hundreds of thousands. Life insurance, if when you take it out, was pretty healthy. It's £6 or £7 per month for £100,000 of cover. So to have a £500,000 policy could be 30, 35, 40 quid a month. So it's within a lot of people's budget, but a £500,000 payout going into your estate could easily push that estate balance over the threshold, and then you're going to pay inheritance tax on 40% of anything over that threshold. And if, let's say, that was the full 500 grand that was over the threshold, 40% of 500,000, yeah, £200,000 of the 500,000 gets paid as a tax to the Inland Revenue. Simply by putting it in a trust, the full £500,000 goes to your family. Why wouldn't you do it? Is it complex? Not usually, as long as your life isn't overly complicated. Does it cost anything? Well, we put them in for free as advisors. And we can even complete the forms for you and just get you to sign them. So it can be an easy process. And it can easily be added to existing policies. You don't necessarily have to start a new life policy to sort that out. So that's me banging on about that for now. If anyone thinks, well, that might be me, I'm not sure it's in a trust or not, then just give us a call. We'll have a chat, send us some details of your policy. We'll be able to tell you whether it's in trust or not, and whether it needs to be, and how that's done. Really briefly, as usual, a quick list of the breadth of the services that we can offer. If anyone wants to chat about any aspects of finance, then here's a list. And really, finally, this is the last page, the various ways of getting in touch with the company. And particularly at the top one, if you want to book just a free appointment, either cut and paste that link or type that into your browser, and that'll access our team's diary. And whether it's a mortgage appointment to chat through anything I've talked through in a little more detail, or anything to do with life insurance, critical illness, income protection, we'd be delighted to have a chat, see if we can help you. Other than that, thank you so much for listening. Appreciate that. If you got to the end, I think that was around sort of 20 minutes or so. And I know time is valuable, but property education can equally be valuable. So thanks for your time and all the best.